Good afternoon, everyone. Thank you for joining us for our second MSX discussion for the year. Today we'll be discussing DIDIC's financial performance for the half year ended June 30th, 2024. So just a brief on the company overview. As many of you are aware, we are an investment holding company established back in 1987. We are one of the largest listed investment companies in Oman, with our current investment book of slightly more than 200 million riyal. Our investments are concentrated in a variety of sectors, most importantly being banking, insurance, financial services, utilities, and hospitalities, among others in Oman. The major investments, all of these are classified as associates in our books. The first being Bank Dhofar, where we are the promoter and largest shareholder. Dhofar Insurance, where once again we're the promoter and the largest shareholder. OIFC, we're the largest shareholder, and it's the leading investment company, the leading company in billing and payment processing in the Sultanate. And Dhofar Food and Investment, where we are actually the second largest shareholder, and it's a diversified FMCG company based in Salalah. We'll provide a little more detail on these associates in later slides. Our major shareholders include some of the most prominent business groups and families in the Sultanate, including Muscat Overseas Group, Militant Trading and Contracting, and FinCorp Investments LLC, in addition to some of the government pension funds, such as the Social Protection Fund. Many of these investors are promoter shareholders of DIDIC. Just a brief highlight of our board. As many of you are aware, our board was expanded in the most recent AGM held in 2024. So we are chaired by Sheikh Khalid Al-Mashani. The deputy chairman is Mr. Tariq Al-Ajeli. We also have Mr. Salim Al-Awadi, who is one of the independent members of the board. His Excellency Dr. Hamad Al-Rawahi is one of the new board members, and he also sits on our Executive Nomination and Remuneration Committee. Sheikh Muhammad Al-Rawas is also one of the new joiners to our board. He also sits on the ENRC. Mr. Umar Al-Sheikh, who chairs the Audit Committee. Sheikh Saoud Al-Mashani, who also sits on our Audit Committee. Mr. Ali Lawati, one of the new board members who also sits on the ENRC, and Engineer Msallam Al-Mashani, a new independent director who sits on our Audit Committee. The main management positions are filled by myself, Ramz Al-Amoudi, as CEO, Mr. Vishal Makwana on my right, our Chief Financial Officer, and Mr. Jamal Rashid on my left, who is the company secretary and the compliance officer for the company. A very brief overview of our investment philosophy and processes. As you would know from reading our financials, our investments are focused on equity instruments issued by new and existing companies across a variety of sectors. Our focus historically has been in the Sultanate of Oman, and as it stands, 100% of our investment book is focused in Oman. We are considering investments outside of Oman. This is something we've been looking at for a number of years now. Of course, with no fresh capital coming in, it's a matter of managing current investments, seeking exits, and making new ones. Inshallah, this year we will be venturing into some markets out of Oman, and we will update everybody accordingly once that happens. We generally aim to abide by a pre-approved asset allocation policy. This is something that is established in our investment policy that is reviewed and are approved by our NRC and board. We generally try to remain within the narrow bands of the asset allocation. However, sometimes it takes a little longer than expected to achieve the target. We're heading towards that right now. We're not too far from where we would like to be in terms of the allocation of assets. In terms of the process, the investment plans are prepared and studied by management and are submitted to NRC for approval. The NRC, this is generally done well in advance. As you know, we are not speculative investors. We focus more on value, and so our investments are long-term in nature, which gives us the ability to work on them to give them a good deal of time in terms of preparing and submission to the NRC for approval. Once investments are made, the performance of our investments is evaluated quarterly. It is reviewed by the ENRC, and recommendations are made for each investment based on certain benchmarks we have established for each asset class in terms of the downward risk we are willing to accept and the prospects of the investment moving forward. With respect to risk management, we do that using a scenario analysis framework. The risk tolerance for each asset class is basically, it comes down to a maximum loss we are willing to accept in carrying value. And we look at that regularly through our investment evaluation and give recommendations to our NRC with what should be done to either mitigate those risks or to transfer them completely. With respect to our investment portfolio, we have 3 subsidiary companies that are fully owned by DIDIC. Those include Dhofar Investment and Real Estate Services Company, Garden Hotel, and Dhofar International Energy Services Company. The total value of those subsidiaries in our books is less than 1 million riyal. Just as a brief, we recently provided, Garden Hotel has been provided to a local operator, and we collect a fixed rent on that. Our investment in Dirus used to hold some minority investments in a variety of companies, most of which have been either liquidated or under liquidation. The Dhofar International Energy Services Company is the company we have established and use for our investments in the utility sector. With respect to associates, which constitutes the largest portion of our assets, with a total value of close to 175 million. Those includes our ownership in Bank Dhofar, our ownership in Dhofar Insurance Company, Financial Services Company, OIFC, Salala Medical Supplies, and DFI. Investment in quoted entities, we have a total value, that portfolio is valued at close to 23 million riyal as of June. The major investments within that portfolio include Bank Muscat, Salala Port Services, Dhofar Tourism, Dhofar University, and some other investments. As you will note, this portfolio is composed of both quoted and unquoted investments. The larger value is in the quoted segment. However, that changes as we manage the portfolio moving forward. We also have some fixed income investments. Those include investments in fixed deposits and a loan to subsidiary. This is basically a loan that was given to Garden Hotel. This gives a total investment book value of close to 205 million riyal as of the 30th of June 2024. Just a brief on the key investments. As stated earlier, all of these are classified as associates in our books. The largest investment we hold is our investment in Bank Dhofar, where we own slightly more than 24%. Bank Dhofar is one of the largest banks in the country. It used to be number 2. It's closer to number 3 in terms of size. Following the merger between Bank Sohar and HSBC, it was established all the way back in 1990. It operates a network of over 118 branches. I think they're in the mid-20s now. More than 300 ATM machines and CDM machines as well. The bank has total assets of 4.8 billion riyal with shareholders' equity of about 568 million and the market cap of close to 500 million riyal. Dhofar Insurance is one of our important associates as well. We own slightly less than 39% in Dhofar Insurance. Value of that investment in our books is about 15.4. That includes the value of certain convertible bonds that were issued by Dhofar Insurance, and they are subject to either redemption or conversion depending on the solvency ratio on any given April. So it's in terms of GWP, it looks like the second largest company in Oman. However, if you look at local GWP in terms of premiums generated only in Oman, it actually comes out on top with a market share of close to 14 or slightly more than 14%. The company was established in 1989, and so it has more than 35 years of operations. It has one of the best networks for insurance companies in the Sultanate with more than 42 branches and 7 regional offices. The insurance revenue for the 6 months has come in at close to 45 million riyal. It has total assets of 123 million and a market cap of 24 million riyal. Another important investment is OIFC, where we own close to 38% and carry it at a value of close to 12.5 million riyal. OIFC is one of the leading service companies specializing in billing and collection and debt factoring. They work with the utilities, telecoms, and with ROP as well now for collections and bill payments. It's established all the way back in 1979. One of its major investments, other than its operations, includes its 13% stake in Bank Sahar, which, following the merger with SSBC, has contributed significantly to an improvement in OIFC's bottom line. It has an investment book of close to 124 million, once again, mostly composed of their investment in Bank Sahar. Their equity stands at 33 million riyal and the market cap stands at 21. The final major associate that we have is our investment in DFI. As many of you would be aware, this is an investment we acquired last year in close to August through a share swap transaction where we transferred our ownership in OGF, Oman Gulf Food Company, in exchange for shares in DFI through a private placement. DFI was established in 1984. It's engaged it's a diversified FMCG company, so it produces dairy products, it does its own packaging, it produces juice, animal feed, it produces poultry through a fully owned subsidiary called Dufar Poultry, a majorly owned subsidiary. It also produces edible oil through its fully owned subsidiary, Oman Gulf Food, which has representative and distribution offices across the GCC. The group revenue for the first 6 months of the year amounted to 41 million riyal. The company has total assets of close to 90 million riyal and a market cap of 16 million riyal. As you will note, we own slightly less than 27% in that company. If we were to take a very brief look at our financial performance, obviously our numbers are public, and so a lot of you would have seen those numbers. As you can see, our dividend and interest income is almost flat as compared to last year, whereas we had a slight drop in the revenue from subsidiary. The unrealized gains on financial assets remain almost the same in terms of unrealized loss, mostly as a result of the fall in the share price of Bank Muscat in the first 6 months of the year. The total expenses and depreciation are in line with last year. They are slightly lower due to the consultancy fees that we incurred last year for the work that was done in terms of the private placement for DFI and the merger for OIFC that we'll touch upon slightly later. Finance cost has slightly gone down, significantly gone down. That is as a result of the pay down of debt. We have reduced debt by making debt repayments last year. Even though the effective interest rate on our liabilities has gone up, the debt reduction and the amortization of new loan expenses that were incurred in 2023 obviously did not repeat in 2024, resulting in close to 1 million riyal drop in our finance cost. Our associates are all improving in terms of performance, and so the share of results from associates has improved this year by about 800,000 riyal. The combination of that has resulted in our profits going up after tax from 2.1 million first half of last year to 3.8 million in the current year. With respect to our assets, as you can see, the total assets are almost flat. This is as a result of the profits that were booked in our associates and resulting in a higher value for those associates. That was offset by certain asset sales that were done earlier in the year to both make the dividend distribution that we made back in May and for the debt repayment that happened last year. Our retained earnings have increased from 60 million to close to 65 million as a result of the profits that have been booked. This is net of the dividend that was paid. And as you will note, our term loans and borrowings have reduced by slightly more than 5 million riyal as a result of the debt repayment that was made at the end of last year. So this is just a graphical representation of what was just discussed. So if we look at total income is slightly lower. This is as a result of the change in the operating nature of Garden Hotel. Now that it has been given out on a fixed-term lease, we no longer book the revenue from that. We book the lease income, and so that results in that reduction. Our share of profits from associates are up by 12%. I think all of our associates are doing better. Of course, DFI was not an associate in the first half of last year, and so is not included in this. However, in the first 6 months of this year, we actually accrued a loss of about 300,000 riyal from DFI. As we will address the DFI status, I think, later in the presentation. Our total expenses, as noted, are down by 14%, mostly as a result of the reduction in those consultancy fees. And our total finance cost has also gone down by close to 1 million riyal due to the pay down of debt and the lack of amortization of origination fees. If we can look at our balance sheet, as we can see, I mean, obviously in total assets, we're almost flat. Our investment in associates have gone up by 4% as a result of the profits booked by those associates. Whereas there was a certain offset in that in terms of decline in the value of investment in equities, as we said, mostly on account of our investment in the reduction in price of Bank Muscat. Total debt has gone down as a result of debt repayment that was made last year of about 5.6 million riyal, and total equity has gone up by 4% as a result of the profits that have been booked. If we just take a look at some of our major associates, so we start with the most important one, which is Bank Dhofar. As you can see, net interest income has gone up by 9% year on year. Their net commission and fee income continues to grow. It's grown by 2%, resulting in a total net profit after tax growing by 20%. We also are quite delighted by the increase on the balance sheet side. So loans have increased by 8%. Deposits have actually grown by higher than that, so by 12%, with the resulting increase in shareholders' equity of 1%. Other positive news coming from Bank Dhofar is the reduction in the gross NPL ratio. So that has gone down to 5.1 from close to 5.9, while the net NPL has increased slightly. Obviously, as you would have noted, for anybody that's following Bank Dhofar over the past few years has been effectively cleaning up legacy issues. And so they have been, I would think, in terms of cost of risk, the leaders in the market in terms of provisions that have been taken, which have weighed down on profits slightly. But we are delighted to see that assets and deposits are growing. And so we expect the results from Bank Dhofar to continue the positive trend moving forward. So far, over the past few years, they have performed as we had expected. Dividend received in 2024 amounted to 5.6 million riyal, which is a 7.75 beza per share distributed, which was a delight for us to see them revert to these numbers again. Dhofar Insurance is also performing very well with a great improvement in performance. So our insurance revenue on Dhofar Insurance is up by 17%. Net investment income is slightly weighed down. It's gone down by 15% as a result of their exposure to DFI. As we will note, obviously, DFI is in a turnaround situation, and so we expect this to reverse in the future and profits to actually start coming from there. The improvement in the insurance revenue performance has resulted in an improvement in net profit by 11% to 2.4 million for the first 6 months of this year. We also note an 18% improvement in shareholders' equity as a result of both the conversion of part of the bond that took place last year and the improvement in profits. So we look forward to further improvements in Dhofar Insurance performance. And it's one of the segments that we remain very bullish on. As stated earlier, the company's market share in general insurance actually amounts to 18%, which is the largest in the Sultanate. But as we said, we believe that in terms of overall GWP in Sultanate of Oman, Dhofar Insurance is the market leader, as they generate more insurance premiums locally than the ostensible number one in the market. In terms of OIFC, as we note, the performance of profit after tax in the first 6 months has more than doubled by going up by 108%. However, as you know, the revenue from operations and EBITDA are actually down compared to last year. This push-up in profit comes mainly from the bumper profits booked in Bank Suhar as a result of its combination with HSBC. Inshallah, we expect this kind of trend or level of profitability to continue. So obviously this 108 will not look like 108 down the line, but we expect the quantum and level of profits to remain as positive as it is now. So the investment in associates, mostly composed of their investment in Bank Suhar, has gone up by 7% as a result of Bank Suhar's profits. Bank borrowings are gradually being paid down, so the 2% reduction in bank borrowings compared to last year is a delight to see. And we see a significant improvement of shareholders' equity, where it's more than doubled from 18.5 to 39.6. The company currently no longer has accrued or carried forward losses, either as a parent nor as a group, which reduces a lot of risk that we had in mind moving forward. So OIFC, all in all, is improving and progressing nicely. If we just look at our own books, as you can see, shareholders' equity has significantly increased by 151% from 2019 to the first half of 24. Obviously, that's a result of two things: the profits that have been booked as of 21, 22, 23, and this current year, and the one-time bargain gain that was booked in 2020 as a result of the change in accounting standards applied to DIDIC. Previously, we carried everything at market value, so mark-to-market losses resulted in a lot of variation in our P&L. We have moved more to a holding company accounting standards, and so now we carry associates using the equity method. That resulted in a bargain gain being booked in 2020. We also would like to note the reduction of our long-term borrowings by a third from 2019 to 2024. We have alhamdulillah, been able to pay down a significant amount of debt through certain conversion of the outstanding 25 million bond that was done back in 21, and through actual debt repayments that are taking place with our senior lenders. And so this trend will continue as we continue to meet our obligations to our lenders. So as a result, our debt to equity ratio now stands at 2.15 to 1, as opposed to being less than 1. Sorry. Yeah, I'm doing the asset ratio, right? Yeah, so it's improved now to less than 1, as opposed to being more than 2 back in 2019. Last slide, sorry. Last slide. This actually concludes our presentation for today. I mean, I'll just give an update. It's not put on the slide. I'll just give an update on two things, if you would allow me. One is in terms of the merger with OIFC. As everybody knows, we had both OIFC and DIDIC shareholders had resolved in extraordinary EGMs to conclude a merger between the two entities. That was challenged at the CMA and now FSA and in court. The court of first instance rejected the case filed by the minority shareholders of OIFC back in April. The counterparty appealed the decision, with the first appeal being heard in June of this year. That was the first session, and the second session, the second appeal, will be taking place in October, following the judicial holiday that was underway. We will update all shareholders with the progress of that case as the situation evolves. So in summary, we are currently at the second stage of litigation. We're in the appeals court, and the appeal is being heard in October of this year. And the final point I'd like to make is we haven't presented a separate slide on DFI. So just to note, yes, we have booked a loss of 300,000 riyal from DFI this year. However, I would like to point out to everyone that when we went into DFI, we always knew that this was a turnaround situation. We believe strongly in the merits of an FMCG business in the region and in Salalah and in Oman. We believe this business will become very profitable down the line. We are currently working very closely with DFI through the board and through various committees to effect a turnaround. A significant number of highly qualified personnel have been recruited. We actually see a significant improvement in DFI's performance on a standalone basis, where it actually booked a profit in the first 6 months of the year. However, there are issues that still have to be worked out across the group, and with the new staff that has been recruited and the efforts of the board and the executives working in the company, we expect this company to turn around soon. So while it is disheartening to see a loss from one of the associates in this part of the year, this is a bump in the road that we always knew would be coming as a result of entering into a turnaround situation. Thank you. That concludes the presentation from my end, and I'll take any questions if anybody has them.
Hello.
Yes, hello.
Hi, good afternoon. This is Bishan Bhala from Vision Capital.
Hello, how are you?
Thank you for the presentation. Extremely elaborate, very well carried out. Just had a few queries. I've been on the previous call, so just a few follow-up queries. You were kind enough to mention the status update on the OIFC transaction. I had another query. One of the points mentioned when this transaction was in the process was that you would require a CBO approval because you would own more than 10% in two banks, which would be Bank Dhofar from DIDIC and Bank Sohar or Sohar International from OIFC. So are those talks still in progress, or have those also been, halted till the outcome comes for this project?
They have not been halted. What happened, obviously, is we had sent a letter to the CBO requesting their approval. What the CBO has done is they have basically been following up with us on the status of the case and how the case has been progressing. So while we have not received a positive response, we have not received a negative response. What we are getting from the CBO is simply requests to update them with the progress of the case, which in my reading, and it's my reading alone as a person, is a positive indication, because I would have thought that if they were going to reject the idea on principle, they would have rejected it regardless of how the case is progressing. So the talks are still ongoing. They are waiting for an update following the conclusion of the appeal process. So we look forward to providing the CBO with the necessary updates sometime in the Q4 of this year.
Noted. So just from a process perspective, let's say the appeal from minority shareholders, if let's say theoretically were to go in your favor, the next step before this transaction concludes would be the CBO approval, right?
Well, yes and no, to be honest. Well, listen, I mean, I'll be honest with you. We would like to have the CBO approval in writing as a blessing. However, we are doing this. The result of the ownership of these two banks is happening as a result of corporate action, as a result of a merger. We have not gone out and actually acquired shares on the market. So it is a bit of a gray zone. But should the merger be approved, should the case be won, then we will continue to proceed, and we will continue to engage with the CBO. At the end of the day, CBO is an important regulator, and you want their blessing. But the process will continue regardless.
Understood. Makes sense. Thanks for the clarity.
Thank you.
Next question will be with regards to the divestments. On a couple of presentations back, you had mentioned about strategic assets and assets that you're looking to liquidate, and I think, if I'm not mistaken, kindly correct me, I think that number was, I'm not sure, I don't want to quote a wrong number, probably 50-60 million over the next, let's say, 3 to 5 years. What tangible divestments do you see over the next, let's say, 12 to 18 months from your experience?
Well, just to correct you, I mean, that 60 million figure was the post-merger figure. So, I mean, I think you got that number from our discussion, the presentation we made on the merger. So that actually includes the non-strategic assets that sit both in OIFC and DIDIC. It doesn't include DIDIC alone. So DIDIC's standalone number is obviously significantly lower than that. If we say over the next 12 to 18 months, obviously the definition of strategic, non-strategic changes with the situation of the investment as well. So I would say maybe at 20% of our non-strategic book, which is composed of one investment, could become very strategic should a certain event take place. And we are hoping that might take place sometime this year. With the balance, we've actually made some of those exits earlier in the year to generate the money we needed to distribute dividends and pay down debt in December. So if we are to say over an 18 to 24 month horizon, I would say we would probably get out of all of them.
And what would that amount be, ballpark?
In our case, I mean, assuming if we take the whole thing,
only DIDIC. Yes, yeah.
Only the DIC. So I mean, I'll just do a very quick number in my head.
Sure.
We're talking about 7 or 8 million, I would say. No,
Right,
less than
right.
that.
Okay, fine.
6 million. Yeah, it's probably less than 6 million, actually. Yeah.
Okay. So on the higher end, probably 6 million is what you could raise from divestments from non-strategic assets over the next 24 months. Let's just keep it that way. Right?
Well,
That
yes,
makes sense.
this is not a cap we're giving. I'm quantifying the assets that we've already established are non-strategic in terms of we don't want them. Obviously, exits also take place for certain assets that don't fall in either bucket, right? So I mean, obviously, it's all in the eye of the beholder. When we say strategic internally, we're honestly only talking about 2 or 3 investments. We're talking about Bank Tufar, we're talking about OIFC, we're talking about insurance, and recently maybe you can say that also includes DFI. So for us internally, when we strategic, these are the strategic ones that we're focused on. Everything else is effectively non-strategic. But when I'm saying that we're looking at maybe divesting 6 million, these are, let's say, within the non-strategic bucket, assets that have already been clearly earmarked that they are no longer of use to DIDIC as a group. So just to be firm a bit with what we're discussing, when I say non-strategic, it doesn't mean that these are all bad assets or these are all assets that have already been put for sale. That's not what we mean.
No, I understand. I think you've been very clear. So I was just trying to get a sense on what number we're looking at, not anything else. And I completely understand strategic and non-strategic is also, a very contingent sort of concept. So that's fine.
Exactly.
If I look at your cash flow statement, you made a repayment of 3.69 million real during the first 6 months of 24. And the next figure I look at is your guidance or the number in your notes for the next 12 months, which is 7.8 million real, right? And so how much of that is over the next 6 months? And if there's a split up of that, is it equivalent to 3.9 million or is it the entire, just to get a sense of
the way our debt agreement is structured with senior lenders, it includes certain payments that are structured repayments where you have to pay them, and those fall on a June of certain given years. And there is another payment that basically we could prepay or we can repay the debt without accruing any kind of prepayment penalty that could take place on December. So the number you're referring to includes that, so to speak, optional repayment in December. That's actually more than 50% of that figure. So that is a tactical decision we make based on whether we've generated the exits of those non-strategic assets in time, what our forecast for interest rates is. So that's a decision we generally make in Q4. But effectively speaking, we don't have any senior debt prepayments to be made until June of next year.
Okay, so what number are you targeting in the next 6 months, if I may just understand that from you?
I can't give you a target right now, to be very honest, because as I said, it's all tactical. As you know, I mean, we've discussed this before. As a holding company, we rely on asset sales generally to pay back principal. I mean, our income, our dividends, those will pay interest, will pay our expenses. Principal is paid through asset sales once we've generated the capital gains or the kind of returns, total return we're looking on investments. So we can't really operate with talking about a target. We expect interest rates hopefully to go down. So that reduces the pressure in terms of the need to repay for the next year. There is no specific target in mind. If we were to generate an exit from the exits we're working on and we had the cash, we will then take the decision of whether is it better to pay down debt and reduce that interest expense, or do we have an investment opportunity where we can generate a return in excess of that carrying cost? And so that's a tactical decision that we usually make towards the end of the year once we see where the chips have fallen, so to speak, in terms of the asset sale program.
Fair enough. I appreciate the answer. Next is with regards to the interest rate on your loans. Assuming that interest rates are going southwards and we expect, let's say, a rate cut, one could only guess when the timing is, but at least the sentiment is that there will be a rate cut. Let's say if there were to be, just to understand the impact or sensitivity of rate cuts on your finance cost. So let's say every 50 or 100 basis point interest rate drop, what sort of drop in finance cost will
it will almost be a one-to-one commensurate drop. However, there would be a lag. Just to give you an explanation, obviously, Oman does not have a specific benchmark rate. The benchmark rate we have in our senior debt is tied to the weighted average fixed deposit rate given by conventional banks. So as interest rates fall, that drop in interest rates will not be reflected in our cost of finance immediately. We will have to wait until that general lag takes place. So as banks absorb that reduction and then down the line start reducing the rates on their fixed deposits, only then will we feel it. So we would expect a lag of anywhere between, I would say at least 6 months, between any action by the Fed and any tangible effect on our own borrowing cost. However, having said that, we are continuously engaged with our senior lenders. Obviously, the way our finance cost is based, it's based on the weighted average fixed deposit rate, as I said, plus a certain spread. We actively engage with them on the appropriateness of the quantum of that spread at any given point of time. So while our interest rate is effectively floating and fixed on paper in terms of how it's calculated, there is a certain amount of leeway through our discussions where we might be able to hopefully bring forward that reduction, because I feel that the drop in Fed rates is obviously going to happen no matter what.
Understood. Next query would be with regards to sort of the borrowings that you have, and you mentioned that the debt to equity has declined from, let's say, 2.15 to 0.58, and that's commendable, as a company. I'm asking more specifically in terms of what is the optimum debt to equity sort of configuration for DIDIC as a strategy, or is that contingent to sort of what opportunities you foresee? Because you mentioned you're looking at a couple of overseas opportunities or a few overseas options. So just to understand, because clearly you should be comfortable given the overall sort of quality of assets that you hold. What sort of leverage you think you can bump up from here if you see the right opportunity?
I'll tell you. We do not look at it from a debt to equity ratio perspective alone. Obviously, from in terms of covenants, yes, our debt to equity ratio cannot exceed 1.1, I believe. Obviously, we have an interest coverage ratio, the standard debt covenants you get in terms of any kind of borrowing arrangement. But these are in reality not our guide. These are the floors of what we're looking at. Our guide in terms of making an investment, and you're right. We do have a capacity to borrow. It's not that and we are looking at diversifying our investment book through probably some kind of leverage arrangement down the line. But what we look at really is that new borrowing, is it being serviced by that new investment in an appropriate manner? What kind of carry does it come with? Because, if you go into an equity in international market, the dividend yield is generally not going to cover your finance cost. So you cannot do it all financing. So this is how we look at it. It comes down to how we project cash flows. Cash flow projections are our guide. It's really not the covenants themselves. So on the face of it, you're absolutely right. In terms of debt to equity ratio, it's quite apparent we have additional capacity to borrow. However, we would only deploy that. We would only move in that direction should our deployment of that additional borrowing generate a yield and a total return that offsets both the borrowing cost and provides a significant equity return to my shareholders. So we look at it by looking at cash flows, pure and simple.
No, that makes sense. But I was just asking in terms of, let's say you find a great opportunity, and now you're like, okay, can I raise the debt? Now, based on what you've told me, your equity stands at, let's say, 134 million, which means with a borrowing profile of 77 million, you can potentially, of course, I understand you wouldn't probably take that kind of a leverage, but you could potentially raise easily 50 to 70 million if required.
That is true.
Right.
Okay, absolutely true. Just to simply, yes, what you're saying is right. We can potentially raise close to 50 million. We will only jump off that cliff if we know we're jumping into a very deep pool. Yeah.
I completely understand, and I endorse you. I just wanted to get the numbers right. Last query from my side. You've been very patient to answer my query, so just one last one from my side. Assuming the OIFC transaction goes through and assuming Sohar becomes a part of the portfolio, etc. Now let's say down the line, either Dhofar or Sohar need to do a rights issue. So that's something strategically, strategically, not so much for Dhofar because that's been a legacy sort of holding. So I'm pretty sure you would strategically want to maintain your holding. But let's say for Sohar, strategically, would you be keen on the rights issue, and B, in terms of the amount, you've already answered actually that you have the capacity to borrow. So that I don't see as a problem. And also it answers your dividend yield, query, because the yields are attractive. But more in terms of strategy, or is it too early to ask that question, and we should wait for the transaction to conclude, the merger to go through, and
Well,
and
I
then sort
think
of ask this? I'm just picking your brain
no,
on this.
I can answer you in terms of the hypothetical. I mean, I'll be honest with you.
Yes,
Obviously, because
absolutely hypothetical.
yeah. I mean, because we
Sorry.
currently
Absolutely
don't
hypothetical.
own Bank Sohar, we are not in on the details of what's happening within Bank Sohar. But even if Bank Dhofar were to do a right issue, our question will always be, why are you doing it? How will you deploy these funds? And what kind of change will accrue to the bank and to me in terms of both cash flow and share of profits down the line. There's
Right.
accounting issues you have to take account of, there's cash flows, and there's P&L. So the same questions will be asked to whether it's Bank Dhofar, whether it's Bank Sohar, whether to anyone, right? I mean, if they're doing the rights issue because they're going to expand into a very lucrative market, and so I will get an ROE on that, then yes, of course, I will borrow and contribute. But if you're doing it because they want to buy a new swanky office building somewhere, we might not be too keen on participating. It all depends on why it's happening, yeah?
Perfect, great. And just now that you picked on that, just the last query, in terms of ROE from investments. So in terms of return metrics, do you look at ROE at an individual sort of asset or a group level? What's an aspirational ROE for, let's say, DIDIC? Or what are the other key metrics that you sort of benchmark yourselves to?
See, at the end of the day, we are a portfolio, right? I mean, regardless of how we account for it, regardless of what the accounting standards say, eventually, at the end of the day, DIDIC is a portfolio of investments. So we look at ROE, but we also take account of covariances, correlations, what is the optimal mix of those portfolios, and that is how we arrive at our target asset classification or asset mix of our portfolio. Now, we're not there just yet, but we look at everything that a typical portfolio manager would look at. We'd look at their betas, we'd look at the ROEs, we'd look at what alpha is being generated. So we look at it as a portfolio. And I believe that's probably the only way to look at it.
And within that subset of multiple metrics, whatever percentage goes towards ROE, what would that number be? Let's say northwards of 10, 10, less than 10, just to understand.
It's obviously it changes with the status, with the risk-free rate, once again, as a portfolio, right? So whether you use CAPM or you use a build-up model, you always use a certain model based on the current characteristics of the market to build what is the target return to my shareholders. Now, for me, and that is not something that we publicize, it is not something that is greatly debated. It is a guide that me and my analysts use internally. So if I give you my view, I wouldn't look at anything. And now, obviously, this is not something that we're meeting with every single position that we own. But as I said, we look at future prospects as well. But I would not be looking at a new investment that generates less than 15% if it's equity.
Wow. All right. No, that's fantastic to hear. Actually, as an investor and an analyst, that's great to hear, because at least that tells me that you're looking, or you will put pressure on the companies that you invest in to achieve that target ROE.
Absolutely,
right?
absolutely.
That's
yes.
great to hear. That's
Yes.
fantastic to hear. And just the absolute last, I promise, is the last one. In terms of dividend, we've seen a resumption of dividends at 2.5 Baisa. Sort of, what is the strategy over there, and sort of, is there an aspirational number over there? Is there a payout ratio number over there? If you just give us some, if possible, and I understand it's a shareholder decision, so if you want to defer it to the next.
I think benchmarking it using a payout ratio does not make too much sense for a holding company, because most of our profits are shares of associates, right? I mean, if you're a factory or an operating company, payout is probably a good guide. A bank, yes. For us, no. However, the simple fact is, we believe that our shareholders should get dividends on an annual basis. We think that dividend payment is something that we as management should ensure happens. However, the quantum of the dividend is difficult for us to predict because of the way our cash flows are generated and because of the way we need to pay down debt. So we would generally, if I would say, I would like to benchmark what kind of dividend I give using a yield function rather than a payout function, but then I cannot commit to one either, because of the way my cash flows are built. So what I can commit to my shareholders is we believe we've put ourselves under pressure internally to make sure that we are in a position to pay a dividend during the first quarter or first few months of any given year. The level of that dividend can only really be gauged towards the end of any given year, because it's very difficult for us to predict. Sometimes that level itself can only be gauged in the first quarter of the dividend of the year in which the dividend will be paid, because that's only when I get to know exactly how much cash flow I'm getting in from dividends. While historically we've been very good at predicting it, but we have made a few mistakes here and there have been some unwelcome surprises as well. So we'd be very reticent to give a certain specific figure in this forum or any other forum, really.
Understood. And in the event, let's say not over the next 24 months, but let's say down the line, over the next few years, if there was an exit event, which is over and above your sort of, debt schedule, where, the fixed portion is paid and the variable portion is paid, that would go towards further debt servicing in terms of prepayment, or would it be like a one-off
once again,
cash event?
Once again, it all depends on what our cash flow projections tell us at any given point of time. You could imagine we might get a bumper exit a year down the line. I pay down what I need to pay down my debt. I have free cash flow I'm sitting on. Then it becomes a typical investment decision. Can I deploy this cash somewhere that will generate that 15% plus that I'm targeting? If not, then I'd rather pay down debt or maybe even distribute to shareholders. So once again, that would be a decision made given the circumstances on that point of time.
Noted. Well, thank you so much for patiently answering all my queries. Wish you all the very best. Yes, thank you so much.
Thank you very much. It's always a pleasure to get your questions. Thank you. If there's no other questions, we can conclude the call. We'll just wait for a couple of minutes for anybody to raise their hand. Okay, thank you very much, everyone. That concludes the presentation for today. This will obviously be uploaded to the relevant platforms where we generally upload these presentations, and our investment relations department is always available to answer questions to any shareholders. Thank you very much.